If you've ever glanced at a financial chart, you've seen them. Those little red and green bars we call candlesticks. They're literally everywhere. And they're supposed to tell us a story about what the market is thinking. But what that story really means? Well, that's one of the biggest arguments in trading. Are these things actually useful signals, or are they just random noise?
And this whole question really kicks off with a story that's probably way too familiar for a lot of traders. A user over on Reddit posted this exact chart after a trade went totally sideways. He thought he saw a really clear signal. He did exactly what the textbooks say to do, and he still lost money.
And that's the big question, right? That's what we're going to unpack here. If these classic patterns are supposed to give us an edge, why do so many people, beginners and pros alike, still get burned by them? Okay, let's really dive into this.
So here's what happened. The trader spots not one, not two, but three red hammer candles, one after the other. Now, in the world of charting, seeing a hammer candle during a downtrend is usually considered a huge flashing sign that things are about to turn around and head up. Seeing three in a row, that's supposed to be a textbook long entry. But the market did the exact opposite.
Okay, so to figure out why this trade went so wrong, we have to go back to basics. What are the official rules? What do the books that everyone reads actually tell us about these patterns?
At its core, you can think of every single candlestick as a mini story about a battle between buyers and sellers. That thick part, the body, it shows you where the price started and where it ended in that time frame. And those thin lines, the wicks, they show you the highest and lowest points of the fight. Green means the buyers won that round, red means the sellers did. It's basically a snapshot of market psychology.
And that brings us right back to the pattern our trader saw, the hammer. See that long lower wick? That shows that sellers they really tried to push the price way down. But the buyers fought back with everything they had and managed to push the price all the way back up to where it started. So the textbook says, aha, the sellers are running out of gas. A reversal is probably coming.
And the hammer, is just one of dozens of these named patterns. You've also got things like the engulfing pattern, which is when one huge candle just completely swallows the one before it, signaling this really dramatic power shift. The point is, there's this whole library of formations, and every single one is supposed to have a predictable outcome.
But here's where it gets interesting. What happens when we take that clean, textbook knowledge and throw it back into the mess of a real-time chart? Well, when other traders on Reddit looked at the exact same pattern, the advice they gave was, well, it was all over the map.
So on one hand, you had a trader who saw exactly what the textbook described. They're looking at it and saying, hey, look, the volume is picking up. You've got three hammers. This looks like buyers are getting ready to step in. This could be a solid buy if you've got the patience for it.
But then, almost immediately, someone else looks at the exact same information and comes to a totally different conclusion. To them, this isn't a clear signal at all. It's messy, it's ambiguous, and the smartest move? Just stay out of it. Don't touch it.
Then you get the real skeptics. This person just comes out and says it. Patterns like the hammer, on their own, just aren't very reliable. And they even go a step further, saying that's true for most candlestick patterns. Ouch!
And finally, maybe my favorite, this beautifully blunt piece of advice. 2 words. My advice is don't. It just perfectly captures the chaos, For every single trader who sees a clear sign to buy, there's another one screaming that it's a trap or that it means absolutely nothing at all.
So if you step back from all this conflicting advice, what's the one thing that experienced traders seem to agree on? It's this: a pattern by itself is pretty much useless. It's like hearing one word out of a full sentence. You need the context. What's the volume doing? What's the bigger overall trend? Is this happening at a major support or resistance level? A pattern isn't the answer. It's just a clue.
This whole debate among traders, it naturally leads us to an even bigger, more fundamental question. Let's just forget about context for a minute. Is there any actual, statistical, objective proof that these patterns work at all? Or is this whole thing just a fancy version of financial astrology?
Well, when the quants, the people who actually crunch the numbers and backtest these ideas against decades of data, get involved, the results? They're often not great. This quote comes from a review of a book that did exactly that, and the conclusion was that a lot of these classic, beloved patterns work no better than a simple coin flip. They just don't have the predictive power everyone claims they do.
And the core of that skeptical argument is that these patterns aren't some objective signal coming from the market gods. They're more like those Rorschach inkblot tests. We tend to see what we want to see. And if they do work sometimes, it might just be a self-fulfilling prophecy, meaning enough traders believe a hammer is a buy signal, so they all pile in and buy, which pushes the price up and voila, the pattern worked.
Okay, so if the stats are shaky and everyone interprets them differently, should we just throw out candlestick charts altogether? Are they useless? Well, not so fast. Maybe the problem isn't the tool itself, but how we've been trying to use it.
And this quote just brilliantly nails that shift in thinking. This is from Steve Nison, by the way, the guy who basically introduced candlestick charting to the Western world. And even he argues that we shouldn't think of these patterns as rigid scientific laws. They're more like flexible guideposts. They're not for predicting, they're for interpreting.
So here it is. This is the synthesis. The real power of a candlestick chart isn't in telling you what's going to happen. It's in showing you, with incredible clarity, what is happening right now. Each pattern is a story about the emotional state of the market, the real-time balance of fear, greed, and indecision among millions of people. So a much more robust approach looks something like this. Yeah, you start by identifying a pattern, just like the books say, but that is only step one. Then you have to analyze the context. Is the trend on your side? Is volume picking up? And this is crucial. You wait for the next candle to start moving in your direction to confirm your idea. And no matter what, you always manage your risk, because no pattern on Earth is a guarantee. It's all about probabilities, not certainties.
Which in the end brings us right back to our central question. Maybe candlestick patterns are less like a crystal ball that can predict the future, and a lot more like a Rorschach test that reveals our own biases, our own discipline, and our own understanding of the market's mood. The pattern itself isn't the signal. How you interpret it with all the context is the real skill.